All right, what's going on, everybody? Welcome to this week's episode of the Wealth Workshop. I'm joined, like usual, by Jacob. Jacob, welcome.
Thanks, Tom. Had a great
How you doing?
weekend. We uh we actually caught some fish this weekend. As you know, I'm a big fisherman, and it's been pretty upsetting the last few weeks. And so this was a nice turn of events.
Hey, there's something special about fishing. Not gonna lie.
Yeah, I heard you saw quite the setup on Pelican this
It
weekend.
was wild. Yeah, I saw. I was with my three and a half year old boy. We had a special father son weekend out at the lake. It was awesome. After like the crazy, I will say our family's still in a little bit of a funk, but yeah, we were. I saw quite the setup on a kayak of all. It made me think of you. But I got to
uh,
tell you a funny story. So last week, obviously, I wrote about the Chase Sapphire Reserve, and just like I don't want to say betrayal, but like, wow, that is so annoying. Uh, when uh, when I got the notification from my brother-in-law, he texted me that the annual fee is going up $800. So, anyways, I wrote about it last week and just wrote about how just how much how entrenched we as people are in the financial system, and and to some degree, like we have control, right? Like I don't, because the Chase Sapphire Reserve is going to be $800. Like I have the choice as a consumer, right, to keep the card or not. Of course, it's like really annoying to have to do all the auto pays and all the software that we have like as a family synced in. So I wrote about it because I was annoyed and just told the audience that hey, this is just how it works, and you've got to stay on the ball with this stuff. Otherwise, like you just get feed away, right? And so I get home on Thursday and I got this like beautiful package from Chase outlining all of like the supposedly great features that are coming. And then of course they reminded me of the fee, but I just thought that was really ironic.
so is it actually great features? Like, is it actually any better? Like, are you going to get more points?
Well, I think they said there was like $2,500 or something worth of like freebies, but it is like the amount of strings attached to get that, the full value is a lot.
Well,
So
clearly Chase always wins, right? Like they're not offering just a bunch of free money. Like they're banking on people not actually using all of the
yes,
freebies. Yeah.
it's like I think from Chase's perspective, it's like insurance. So like most people lose, out of the deal, but some like gain tremendously. So what ended up happening when that card launched? I mean, it was like it was a viral credit card, and you remember this. I remember talking to you about this. Like my wife and I actually got we each got our Chase Reserve card for the 100,000 points. So we like went to Europe by with this card, and like we had like 200,000 Chase points. Actually, it was more than that because we had to spend money to get the points. Um, and fast forward 5 years or however long. No, we've had it for almost 10 years, I think, or 8 years. We canceled their card because the fee kept going up, and we're like, we don't need two separate cards. It was getting confusing just with like more kids and the complexities of life. But we got, I mean, for all intents and purposes, I mean, it was great. And I remember when the Chase Sapphire Reserve came out, I think J.P. Morgan had to take a write down of like a few $100 million because of how much money they spent in points
Oh wow.
for the amount of people. I think it was like 300 to 400 million back in the day, a write down of, and like we were part of that, right? Like we booked flights to Europe and, with these Chase points. So it was great. So I don't want to say, and I wrote this in the newsletter, right? Where it's like the card has been awesome, right? And then just before this too, on CNBC, I don't know if you saw this out at the pit, but there's like this ad of the new card, right? And they're touting the upgrades and like what the card's going to look like when everyone gets new cards. So, anyways, the Chase Sapphire Reserve and the premium credit card game is just it's getting much more expensive. I was reading about over the weekend, Citi's coming out with a new card, like a $500
Oh
card
really?
to compete with
Oh, I heard
the
about that.
yeah. So they like know people like myself are in the market for a new credit card. And I've thought about, switching over to Amex because they're all, like all of these, they're just gearing up for war in Q4 on credit cards.
Is Amex still one of those that's really restricted to where you can use it versus like the Chase card?
I don't know
Or
because we don't ever.
yeah,
We have an Amex card, we have a Delta card that we don't really use. We just
sure.
have it to have it, and so I don't know. I haven't been a big Amex user for probably 10 years.
This Chase card's now more expensive, I think, than Amex. It's the most expensive card, right?
Yeah, but
Yeah.
Amex is going to get an upgrade cycle. They're all getting like air quotes upgraded, so higher fees and more like brand partnerships. Um, but as consumers, we're all left. I don't want to say holding the bag necessarily, but it's just annoying when you've got to make these decisions. So they no doubt launched this though in the summer, right? They
Hmm.
this is like a pretty dead time, even at Fjell, right? Like a lot of our clients are they're just on vacation. They're doing other things. So um, anyways, let's talk about Jimmy Buffett's estate for a second. This is obviously what I wrote about this week in the newsletter, and what a like horrible situation.
Yeah, well, fill me in. What's the highlights here?
Okay, so 2 years ago, Jimmy, died, and I was at
Hmm.
the lake when I was sitting on my parents' porch when I figured out that he died. I think that's where I was, or that's memory tied to this. And I was like, oh dang, like Jimmy Buffett died. That's really sad. He was, I think so many people have good memories with him because like from the like the locations that played his music, usually like the Caribbean or down in
Yeah,
Florida.
yeah.
So anyways, like I think everyone had like pretty awesome memories with him. And then fast forward a couple years and 2 years in particular, there's just like this massive bitter dispute over two trustees of his $275 million estate. And I wrote about this week because when people are coming into the newsletter ecosystem, we always ask them questions, right? And so many people are just really afraid of what happens to their family after they're gone, particularly with money.
Hmm.
And this is such a cautionary tale of what happens when things go south.
So how did this all start then?
So, so he set up a trust in 1990, right? So back in the
Yeah.
90s, people are like, where did these trusts come from, right? Like, why does this happen? Um, so back in the 90s, even into the 2000s, the estate tax limit was significantly lower. So it's really not a lot of families like today really have to worry about federal estate taxes. It's much more of a common issue to have state estate tax issues, right? Um, but it was way different in the 1990s. So Jimmy set up a trust. He moved all of his assets into this marital trust. So he basically like gave away his assets or to avoid estate tax. And there's some like creditor protection. These things can get pretty complex, but moved a lot of his assets there. And when he died, he wanted his longtime advisor and accountant to manage the assets along with his wife. So what ended up happening was, or what is happening is his wife is mad at his longtime accountant and advisor, and the advisor's mad at the wife. So there's just like this dispute, and they're both trustees, so they both have control. And it's the trust is all of his assets are for the benefit of his wife of 47 years, but she can't necessarily change the fact that for this trust to work and what Jimmy wanted was for there to be an independent trustee. So it's a tussle over the the control of the trust and subsequent assets of the trust. But it's ugly.
Yeah, and so the point of the independent trustee is just to protect the trust, or like
Yeah,
protect the estate from just like there's a person there that's not receiving any benefit of it, that's just there to be a fiduciary to the trust.
yes, and for the estate tax to be
Oh,
to be avoided. So there's a lot of reasons why there has to be an independent trustee. And, we won't necessarily get into the nitty gritty of that, but the facts of the matter are, Jimmy died 2 years ago. He's got 3 kids, left behind a wife of 47 years. And there's like an extremely public battle going on over what should happen with these assets. And I think, I think I read about this in Barron's maybe last week or a couple weeks ago. I read a lot on my phone, so it's hard to know exactly when these articles are written and like when they're shown to me from the news algorithm. But I was doing some research today, so this is Tuesday morning on this, just for the newsletter that most people are seeing this episode on, and I was shocked at how many news publications picked up the story.
Oh, really? Yeah.
Yeah,
Well, I suppose, I mean, it's a big money story, but then it's also like Jimmy Buffett is an artist, like a creator. So it's like pretty mainstream as well. I'm sure
yeah,
it's each has its own angle
yes,
or
and it was
take on the
on
story.
like. So like I read it from like obviously from like the wealth management perspective, right? So like this is, we read very specific things to sharpen our skill set for clients. But yeah, like MSN.com was talking about it, like the Palm Beach Daily or some like very specific South Florida news publication. I mean, there was a lot of publicity on this, and I couldn't help to think, but like, wow, this really sucks for the family.
Yeah. And I don't think it comes without like I think there is some real issues here. One of the things that I was reading was that the estate itself, so you said it earlier, 275 million, was only producing like 1% returns, like $2 million a year. And there's claims that like because he owns the Margaritaville franchise or like that the restaurant chain, franchise chain, whatever it is. And it was like producing 18 million a year of profit. But the estate was only producing 2 million of returns. That was a big part of I think maybe some of the dispute here is like, well, where's the money going? And his wife was like, I have to take from personal assets now because the estate isn't providing for me.
Yeah, and the problem is that from my understanding, like the assets that she has outside of the estate, she probably has like some cash and maybe probably some like, relatively modest investment accounts,
Mm-hmm.
maybe like, some, like a 401k. Well, it wouldn't be a 401k, but maybe like an IRA or,
Yeah.
she probably has some like nominal assets. Like they wouldn't maybe be nominal to you and me, but like for somebody who's, like this family who's lives, very nice lifestyle, they would be to her. So within these court cases, this independent trustee, this longtime associate of Jimmy, was like, well, you might need to sell your personal real estate to
Mm.
fund your lifestyle. And she's like, what? She's like, there's this $275 million estate. And why would I have to sell my house to fund my own lifestyle when there's, almost a third of a billion in net worth? But I think it's worth showing here. And I put this in the newsletter, right? But like, here's a breakdown of the assets within this trust, sort of. So they have $34.5 million in what was within the estate filing as real property. There's $15 million in equity in a company called Strange Bird Incorporated. There's $2 million in music equipment, $5 million in vehicles, $12 million in other investments, and then an $85 million equity position in Margaritaville.
Mm.
So, when I was looking at, the very honest question is like, well, how can an estate like that be producing less than 1% in income? It's like, how's that even possible? But then you read through, well, what's inside the balance sheet, and you're like, okay, got it. So
Yeah.
$34.5 million in real property, like what would that be? That's probably, he's got an incredibly cool boat. I don't know if you know about his fishing boat, but I do. He took like two different types of fishing boats. So he took like this really cool catamaran, and I read about this years and years ago, like this really cool like offshore cat, and then he put like another boat manufacturer's like it's hard to like the fly bridge is what it's called. So
Mm,
he like combined two boats together, and it's like the super custom, super cool, like best of both worlds. You can only do this if you're Jimmy Buffett type of thing. But as like that boat is probably in that $34.5 million in real
yeah,
properties. There would be like private planes in there. Like there are assets likely in that part of their net worth that consume, seven figures, right? Like if that's a $3
right.
million boat, he's probably paying, 300 to $500,000 a year, just, or the estate would be, or the trust to upkeep that boat, right? So then like this $15 million equity position in Strangebird, like who knows if that's turning a profit or if they're taking distributions, $5 million
Right.
in vehicles. Like I'm not like, are the planes there, the cars? Like we don't know about that one, but that strikes me as something that's like produce or like consuming cash. Who knows about the other investments? That's maybe where they had some liquid assets. But the
Mhm.
position I think I want to, sit on for a second is this $85 million in Margaritaville, right? So we know that that position produced, I think you said $18 million
Something like that. Yeah.
in, yeah, the thing that what I was reading about was it was like $14 million in distributions over 18 months. So we know that thing is producing cash, but I believe it's he only owned like 20% of Margaritaville or something. So
Mm,
he brought on investors and he owns, like he was a creator of it, but he had investors to really expand everything. And so what I think potentially happened there is like that thing produces a lot of cash, but they don't necessarily have control over it. So if you think about like Jane, his wife, like she's like pretty far removed from the decision. So she's like a co-trustee on this trust. And then
mhm.
like that, like the co-trustee she's fighting with is probably been working with the control group of the Margaritaville, like that asset on their balance sheet. So she's like pretty far removed from the place of control, even her husband basically isn't like was Margaritaville.
Right.
And so like I think what ended up happening here is like that Margaritaville produced a lot of cash, created a lot of taxes, and a bunch of that income was just created to pay taxes to all the lawyers involved and the accountants of managing this type of estate. And there's a lot of the other assets are just consuming cash, and she's left with like not a lot of income.
Yeah. So the coming to a head here of like, well, how does this estate actually produce income for her? Is like, well, if she doesn't need $5 million of vehicles, whether it's planes or cars or whatever, like liquidate, get more liquid so that there's less cash consuming assets on the estate's balance sheet.
But she doesn't have control of that. That's the problem.
Oh, right.
So
Because the independent trustee is well, they both need to sign off on this stuff.
yes, yep, and that's where the rub's at. We're like she sort of is in control, but sort of not. And so this guy is like, well, Jimmy put me here to protect her, right? And she's like, well, like, what if she doesn't want the boat, right? Like, can she sell the boat? And so obviously Jimmy would be like, well, if my wife doesn't want my boat, like, yeah, of course she can sell it, right? But the that now is like his wishes are now being uh interpreted by two different people. One who's worked
Right.
with him for 35 years and his wife for 47 years. Just what a horrible situation.
So two questions here. Like, how do you avoid this? Or like, how do you, maybe fix it from here even? Like, what, like, I don't know, for like people that actually are setting stuff up like this, what is actually going wrong here? And like, what was like maybe a potential solution before or after now?
So I think it's fair to say that like, so what's not going to change is this trust is set up to benefit Jane and his three children. So like that's just not going to change. What likely is going to change is who are the trustees, right? Like Jane's likely going to be a trustee for the whole time. But I think she's gunning for a different trustee, obviously. And Rick is earning, $1.7 million per year to manage this trust. So this is like his livelihood is probably tied up in this. And then he also is like fiercely loyal to his friend, Jimmy. So, the fix from here is I don't know. Obviously the trustees aren't getting along. Um, then like, how would you avoid this, right? What I wrote about in the newsletter was, ultimately it's just a game of communication, right? Of having really, really honest questions. Because Jimmy, I think probably like assumed that Jane and Rick trusted each other or got along maybe more than they did. I don't like that. That to me is the solution for people who are following the stories. Like you have to talk and you have to have these hard conversations while you're alive to avoid this just disaster. Because it really is.
It is a disaster. Yeah, not a situation that I would want to be in. I guess the other solution is to just not put everything in trust with an independent trustee, and then you obviously have to pay the estate tax, which is less than ideal as well. But
Mhm.
I
Yeah,
mean,
and like
that
you
would
you
fix
can't
the
ever.
problem, but you would be shelling out a lot of money.
Yeah, but then when you look at like, I think what's hard about this is like when you look at the balance sheet, you're like, okay, so the estate tax would be $80 million. Like, well, where's $80 million going to come from, right? Like they'd have to sell Margaritaville. They're like, well, we don't want to sell Margaritaville. That's like, so I think some of this stuff is like, it sounds it's like we'll just pay the estate tax. Like, well, it's a lot harder to. I mean, it's in practice, it's a lot harder because the assets are not normal assets, right? Like they can't just like be flipped into cash. And the IRS knows about this, right? Like there's these operating companies are just they're difficult and they're confusing. Not confusing. They're complex. So um, it's so I think the quandary here is like it probably needed to do something like this, right? Like to avoid this situation. But like how this is played out clearly wasn't right either. So I just can't think anything more than just consistent, honest conversations with the right people. And the other thing too is like, when this was created, it was like they were shooting a gun. It was a one-way door. It was a door that you can't undo, which is also very challenging about some of this like really, really high-end estate planning. So, but for people who don't have 275 million, which is like 99.99% of everyone, I mean, it's still the game is just you have to communicate, have the hard conversations, or else somebody else is going to have them for you, and it may not turn out how you want them to.
Yeah. All right. Well, let's move on to another. Well, I think that these folks also maybe have a lot of money coming their way, or I guess not coming their way. It came their way. We use Figma a lot. Inside of Fjell, we design stuff. Mock up. Our website, for instance. It's a pretty handy tool. They just IPO'd last week,
Yeah.
or like it finally happened, actually.
So on our old podcast, we talked about, I remember I think this was in like November of 2022 or something, when Adobe of all companies tried to buy Figma. And at the time, I remember sitting in our basement talking about how, oh, like, is this the thing that like gets us out of this rut of 2022? Was this big acquisition? I remember we talked about the acquisition at the time was I think it was 20 times sales is what
Yeah,
I
because
believe.
20 billion. Yeah.
Yeah, 20 billion. And I think it was like 20 times, or maybe it was more. I don't know. But anyways, that was 2 years ago. So Figma, yeah, walked away from the deal. And fast forward 2 years, market conditions, like they were bad at the start of the year, and then now they're great. They decided to IPO. And that was a big day. So what's your take on the IPO? Because this was like, I think this wasn't just an IPO, like um, this was an interesting story within the tech space, within Figma's own story arc. But what are your thoughts on like what this means for the market? Or does it mean
So
anything at all?
it definitely means something, because like I think that we talked last week about like the meme stocks being back, like not to say Figma's a meme stock, but just like there's a lot of enthusiasm in the market. I think there's been 3 really successful multi-billion-dollar IPOs this year. There's Figma now, Circle. I can't remember the third one, but it was like really early this year that it went
I
public.
can't
It was
remember either.
another tech company, but I can't think of it right now. Anyway, there's been like a lot more interest in IPOs. Figma initially, I think, was at 20. It was being priced at $28 a share.
Something like
It
that.
oversubscribed to $33 a share, which I mean doesn't sound like a whole lot, an extra, whatever, full, $5. But when you're talking about, billions of dollars, like an extra $5 per share is like, it's a lot of money for the founders. And so there's a lot of interest in just speculation and what could possibly happen here because Figma's IPO, like it's not going to be put in any index. It's not going to be, it's going to be primarily owned by retail investors. Like institutions don't necessarily touch it right away.
Yep.
So it shows like it's kind of like a retail investor sentiment gauge of like how optimistic are just ordinary people in the markets themselves. And so from that perspective, like people are investing and want to invest in the stock market just based on even that gauge, which ultimately is good for people.
And I think like investing, I want to be like a little more specific too, like investing in companies like Figma, because like investing in the stock market, most people, they buy index funds or, they have they've owned Microsoft in their brokerage account forever, or just simply use target date funds in their 401ks, right? But this is like a different type of interest. Like when when people are willing to pay what they paid for a newly IPO'd stock.
Yeah,
That's how I think of it anyways.
It's speculation isn't the right word to describe it. It's just actually this is probably a better way to say it. Is people have risk appetite. Like people want to be taking risk.
Yeah,
which is a great place to be in, just from not just Figma or whatever, like just the markets generally.
Yeah, well, I don't think risk is. I think risk is just not. Risk is neutral, but I think what you're talking about is like, is if you already are invested in the equity markets, like this is wind in your sails because other people are, willing to put their hard-earned money into an IPO. And if they do that, they'll keep buying the stocks that you already own, likely.
Yeah, and I think like this too, like we've talked about this for a really long time, as I think almost everybody else has. But like, there's all this cash that's just out there. People have it in CDs or bank accounts or money market accounts, and I think like you watch Figma go up by 200% in one trading day. And it's really hard to justify your 4.5% CD rate or your 4.25% money market rate. Like it's much harder to sit there and go, well, what about if I put 5% of my cash in Figma? Like I would have an entire year of interest leaving it all in my cash money market account in one day, right? Like not to say that means to do it, but like I think like from what how people maybe see sometimes it's like, well, that's how the math works out.
Yeah, I thought it was interesting that they went. And what a cool storyline too for the Figma team. Like it's something Figma is near and dear to us because we use it all the time, and we're like probably part of the wave of companies that like never really got. We still use Adobe products, but like we're not like we're just Figma people for from a design perspective. Like we use it all often, and we've told lots of people like, hey, we love Figma. It's a great tool. So we're a little partial to their or actually we're just like happy for them. But what a cool storyline. So I want to end the show here on the BLS firing. So I was talking to my aunt over the weekend at the lake, and she was talking about the whole situation, and it obviously is it's a little strange when somebody gets. I don't know who this person was necessarily, but the obviously is very like anything that happens in Washington from the White House gets picked up on the left and the right for different reasons. But Trump obviously fired this person because he was like, your data sucks. Like, and I think it does bring up the point of like, whether you agree with this or not, like if the like what's an appropriate level? I guess this is the question I had. It's like, what's an appropriate level of missing that you can do when the stakes are so high? Because when we are all using this information to to like this information ultimately comes down to how much money are people and like normal families like mine, like yours, other people around the country, how much are they spending, right? And what does that mean for GDP? And so many things are like based on these decisions. And I think, Trump obviously was like, if you suck at your job, you're done, right? But I think the deeper level is like, what's an appropriate amount of missing when the stakes are this high?
You know, it's really hard to say. I think that somebody like the person at the Bureau of Labor Statistics, like publishing the data, they've been publishing this data this way for, I mean, this isn't a new statistic, right? Monthly jobs added, jobs created, jobs lost. Like it's not something new. And in many ways, there's a lot of parts of the government right now that are being politicized in ways that they maybe shouldn't be politicized. Um, but there's the fact is too is like how maybe it's time for like a refresh of like how data is collected. In a lot of
Yeah,
cases, it's like not the person's problem or like the person's fault even. Kind of is because they're the ones
totally.
collecting the data, but
Well,
like
yeah,
how the
yeah,
data is collected is what needs to be updated because like we have like they're still using landline phones to like gauge consumer sentiment. They're calling and saying, "How do you feel about the stock market?"
yeah.
That's horrible. Like we're all on, I don't even have a landline for one thing. Our business doesn't have a landline.
Hmm.
Um, like there's a lot of data collection methods that are just really outdated. And in a world where like Indeed has jobs added, jobs lost statistics, like so does LinkedIn, like these really popular, job boards have huge data sets of like labor statistics, which, I don't know if the BLS should be going into private companies and trying to get this data, but it's also like data that exists in an archive on the
Yeah.
internet.
I think, Palantir is ripping right now because the government is seeing the value in what they do and like in the value of changing how we create data. But I thought that the timing of Palantir's earnings and like how much the government, I think their government this past quarter, their revenue was up 53% year over year. So the government,
Yeah.
the U.S. government, and there's also like whoever they work with that's non-U.S. governments, is huge, right? Like they're spending money to update this stuff. But I did think it was interesting that like that story broke, plus the um, this firing of this person, who's in charge of sharing the statistics, and I think directionally, like what's going on, in the government of creating better systems for data collection. Because even the surveys we have to fill out here for Fjell, I definitely am like, really, like this is like what I'm like. This is how we're doing this. It definitely is eye opening. Um, but also like, I mean, it's just so important. Like it really is. Like if 73,000, or even if you just like do the simple math of like if they're off by 200,000 people and each person makes $60,000, and you think about like, and then the fact that like people save 5% of their incomes, so like 95% of that income is going to be spent in the economy, and you times that by 200,000, and that's just 1 month, and you times it by 12, and you're like, oh my gosh, this is a meaningful amount of money that's being missed or misrepresented, right? So, anyways, I thought that was like that whole like data and like the chain of how data is created, how we use it, and what's an appropriate like amount of misses. And I don't really have a great answer, I guess,
I think
is what I'm saying. But
it needs to be like understood like that it can miss. Like that
yeah,
it'll be adjusted in 4 months because the data takes 4 months to fully materialize. We publish preliminary results and then we publish full results 4 months from now. Like
the
that's where
like
like
is so big.
that's like where some of like the rub here is like we don't want the market to go tank by 2% in a day because the jobs number comes out. But then it's like, well, in 4 months from now, it actually comes back and it's like, oh, wait, we said that it was 75,000 jobs were added, but it's actually 200,000. And then the market rips up 2% or 4% that day because job numbers were so great.
Yeah. It's I don't know. Well,
we had an interesting, actually I have one extra little story here, and then we should close it out. But yeah, I mean, I had a client call in on Monday, yesterday. And he was like, why did the market fall on Friday by like 1 3/4%? Or he used the Dow. Why did the market fall by 600 points on Friday and then it's rising by 600 points today?
On Monday,
and,
I know.
And I'm like, well, I think this is a, classic game of like, oh, here was the number and all the algorithms were trading on like, oh, this is bad news. And then everybody woke up, and like people woke up Monday morning when the markets reopened again. And we're like, okay, we actually digest the news over the weekend. We don't actually believe that this is the case. We're going to buy stocks today.
We're going to buy like the micro dip. Totally. Yeah. It's crazy. Interesting times. All right. Well, hey, let's wrap it up here. Thanks everyone for checking out this week's episode of the Wealth Workshop. We'll be back here same time, same day. If you have any questions too, please submit them. We'll have a link down in the description, or if you're watching this in the newsletter, you can always just reply to that email. We're grateful for your time. Jacob, thank you. We'll see everyone next week.